Thank you for joining us for another edition of Startland News Reports. I'm Austin Barnes.
And I'm Tommy Phelps.
Today, we're diving into Kansas City's venture capital-backed companies, their momentum and struggles, fundraising tips and tricks, and the overall state of VC funding in today's world. But before we jump into that, Tommy, this is an outgrowth of our annual VC-backed companies report. Can you tell us a little bit about how that came together this year?
This year we started the project in May with our data collection partners at Tech Venture Studios at UMKC Innovation Center, with some support on the data collection from the Economic Development Corporation of Kansas City. The goal was to pull together a more comprehensive list of kind of the deal flow and activity in the startup and company space, with the goal of releasing this month with this special some analysis and a full report on startlandnews.com.
And that particular report has actually become a pretty solid resource, so we've heard, for folks doing due diligence with some of our startups here in the region. So always fun to put that out each year. It's always an interesting deep dive into data and numbers. And that data collection is also made possible by our partners at Bank of America, the presenting sponsor of today's conversation, as well as Milo, the Kauffman Foundation, C2FO, and Pipeline.
This community support goes beyond the list today and helps to inform probably the next 12 months of our reporting.
And speaking of reporting, reporter Channa Steinmetz is standing by with a group of founders ready to discuss their VC fundraising experience in Kansas City and beyond.
My name is Josh Lewis, the founder and CEO of UpDown App Inc. UpDown App Inc. is the social media for nightlife, right? When you want to go out, we tell you exactly what to do, where to go, while giving you the opportunity to message, post pictures, videos, and talk to your friends.
I'm Heidi Lehmann, co-founder and president of Kenzen. Kenzen is building a physiological monitoring platform to keep workforces safe from heat, fatigue, and overexertion on the job.
Josh, Heidi, thank you for joining us today. We really appreciate you coming and sharing your experience in regards to venture capitalist funding.
Great to be here.
Very, very excited.
Could you give us a short overview of your experience with VC funding?
You know, generally as the founder of a company, you think you're going to be spending your time in the business, growing the business, and you are, but you're also going to be spending a lot of time on the business. And what that means is fundraising. It's a full-time effort. I'd say generally it's good to make the connections with venture capitalists and other investors. Typically you're not starting with VC, you're probably starting with angels and seed groups, but make those connections before you need them. Let them know what you're doing so they can track you along the way, because it's extremely time-consuming. You also shouldn't raise VC unless you really need it. This means you're selling equity within your company, so you should be looking at venture capital. If you are a high-growth company, you need to capture your market. Otherwise, there may be other ways for you to build it, so it's not for every business.
When you think about building your business, you think about all the technology, the team, how you're going to onboard, all these things that happen within any kind of business. But then when you get to venture capital or raising equity funding in general, it's literally a separate job, right? So for me, it was being intentional about raising venture capital because of, I think, and I'll hop right into it, blacks should definitely get more of an opportunity when it comes to venture capital, but then, understanding the resources about it, understanding how it works. And so I was very intentional about that with our business, and it still is, right? And so with that being said, I realized that that's really a full-time job, raising money, venture capital, even angel investment to some degree with, angels that have done this before. It takes, like 100% of your time, to be totally honest with you, right? So it's definitely a grind. So I definitely agree with everything she said.
You have to be a bit of a glutton for punishment, for sure. And it's, it's a means to an end, right? I mean, your most important job as a founder, a CEO, or someone on the fundraising team is to keep gas in the car. So that's what you need to have your eye on more than anything else, and have other folks on the team that are capable of doing what else the business needs to be successful.
Not every business should raise venture capital. It's just not for every business. It's not for every entrepreneur or founder either. Even building a business, like you can find people that, just by networking, that can do certain things for you in the business. But it's only going to be that founder that is going to be able to raise money and take the beating that venture capital gives, right? So you get 100 no's to 1 yes. That's legit, right? And so with that being said, you have to kind of be ready and be able to take on that. It's about, finding the right VC firm that can partner with you to help you grow, right? And just understanding those things. It's just a full-time job, like I said, and it's not for every business, for sure.
Yeah, and Josh, you briefly touched on it, but you've been pretty outspoken as a young Black founder in tech. Some of the pain points of raising funding, can you kind of dive into that?
Yeah, man, so less than 1% of Black founders in the world, nation, whatever you want to call it, receive venture capital funding, right? And it's a lot of different reasons why. It's not always because they're Black. Sometimes it's because they don't have the resources to understand what venture capital is. When you talk data room and having all your information right and documents and hiring a lawyer and all these things, Blacks don't always have access to resources to fulfill those needs, right? And so the business might be great, but they might not have the resources or understand the back end of that stuff, right? And so being provided with the resources is very, very difficult when you're Black, because we weren't raised on what venture capital was, right? And even just equity funding in general, we're not taught that, right? And so I think we obviously start with the disadvantage, but then, on the back end, it takes action towards investing in Black founders and Black entrepreneurs, I believe. Instead of saying that's what you want to do, but you got to have X, Y, Z, sometimes you have to just do it. And I think that's the curve that I'm trying to figure out, because I've gotten to a point where I tell VC firms no, right? Because if you don't align with my morals, you don't align with what we want to build, then it's no point of us partnering anyway. I'm very strong and outspoken about it because I'm going through it right now, and I continue to. And I think in order for venture capital to take a turn and actually grow, they have to start by attacking that kind of thing, right? The underrepresented founders, for sure, not just saying that they want to.
I think that's a great point. So on the founding team of Kenzen, we're both women and we're also both LGBT. And so I think, especially when you're going for that early funding, it typically is evaluated like this. It's team, technology, and market, right? But it really starts with a team. And most investors are going to invest in people that are like them or things they understand. And why wouldn't you do that, right? You're gonna take a risk. Everybody wants as sure a bet as possible, even though it's venture. So clearly you're taking a risk. But one thing you can do to mitigate it is investing in people like you. So most investors, statistically, are white men, Silicon Valley, Northeast Corridor. So that's why there's been a disproportionate amount of, white male founders that have gotten funded. In fact, just looking at, Black founders. So there was a time when I was focused on a media company. That's not at all what Kenzen does. We do something very different. But we ended up having a TV show that we launched on Aura TV, which was Larry King and Carlos Slim, and was ultimately acquired by Viacom and showed on BET. But it focused on Black female founders that were launching product businesses. And one stat always stayed in my head, and that was from NPR, I believe, that Black female founders raise an average of $36,000 for every $1 million that a white male founder raises for a failed business. So that always stayed with me. But if you think about it, some of the great ideas that these Black female founders were introducing to the market, if I'm a white venture capitalist, I'm just not gonna get it. My instinct might be, this is a great idea, this is really scalable, but I just don't have the market data and I don't have the personal understanding, so I'm gonna back away from it. So I think the first thing is, we need to get more investors that are Black men, Black women, LGBT women, and women in general. So I'll say with Kenzen, we've raised probably too much venture capital at this point, $11 million total. A lot of that's R&D, so non-dilutive capital that we've gotten from grants and things. But once we actually started raising equity-based funding, our first investors were women-based fund and LGBT funds, because they knew Nora and I, they understood our journey, and then they looked at the business and were like, this seems like a great business. So it was really important, especially because women with a technology-based fund, and we're going after industrial workforces. So I think that's a little incongruent to some men. They're like, two gay women who are launching an industrial workforce solution, does this make sense to us? But women funds, especially those up in Minnesota, out of 3M, they really related to us. And then the Gangels, who just, in particular, were looking for, lesbian women who were launching businesses that were going to scale and use technology. Biggest supporters really got us off the ground. Now we're at the point where our KPIs speak for themselves, right? We're starting to show revenue. So then you become a safe bet for anybody. It doesn't really matter if you're Black or white or women or gay or you have three heads. If you've got a revenue producing business, venture capitalists are going to be all over it, and those are later stages. I think the hardest part is really getting those first investors to come in and see your vision and back you as founders, because before anything else, they need to believe in you, because things shift all the times in the early stages. So they have to feel like if things start going south with your initial direction, that you're going to find another one and you're going to be able to pull it out and still hit a home run. So they have to believe in you personally.
To even piggyback on that, from a psychological level, I hear this all the time. Venture capital firms, we invest in you. The business model can be what it is. We can fix that. We can help with that, but we invest in you. And so if that's the case in my mind, how I view it, right? When you talk Blacks, entrepreneurs, you talk female entrepreneurs, you talk gays, right? You say they've lived a life of always being the outcast. They've had to do more work to achieve more, right? So if you're investing in the person, I want to invest in the person that has already took a beating, because this is going to be really, really hard. Like, this is going to be the most difficult thing that you could do ever, right? Like, it's probably not too many things on earth that are harder than building a venture-backed business. And if that's the case, then from a psychological standpoint, for me, it's like, then I want to see what this is about, because I know for a fact that this person is made for what they're trying to do. And I've always just thought that, and that's obviously a strong opinion of mine, but it's something that I think about all the time, just because it's like, you know, if you're investing in the person, then you understand that this person has literally been the outcast their entire life. And that's what you have to be a founder of any kind of business, right? You have to step out on a limb. You have to, you know, take the nose. You have to, you know, figure out your business. You have to be really, really creative. You have to improvise, all these things. And so I've always wondered, like, is that really the case, right? And if that's the case, then why aren't you investing in more underrepresented founders? So
I think that's such an interesting conversation, because we always talk about, you know, diversifying entrepreneurs, and we need to build diverse entrepreneurs, but on the other end of the spectrum, like, diverse investors, like, that's really
that's
important.
a big deal.
A big part of it.
Extremely important.
Really big deal.
And I think you are seeing more funds. So
True.
I know a lot of women funds certainly have popped up. I mean, it started with Golden Seeds in New York, and Boston was one of the first women-based funds, but now there's many. So you've got just a real diversification of female investors. And I also think traditionally, you know, Sequoia, Kleiner Perkins, the larger funds that maybe were dominated by white men, Andreessen Horowitz, certainly, they're making a real effort to bring in diverse partners that can identify those other opportunities that are going to make the fund successful and also give them a more diverse portfolio. I think the same with LGBT funds. You know, you're seeing many of them, and I know a lot of black.
Multicultural for sure. Yes,
Absolutely.
There's tons right now. There's tons compared to what they've.
Compared to what they've been. And I think also, I know one thing that Gangels offers is just making sure that you've got board diversity as a startup. So, you know, we're fortunate. We have a very diverse board in almost every way, but some don't. They may not, right? So even if it's all gay men, they all may be gay white men, right?
Correct,
so
correct.
It's just, how do we have the most diverse board possible? And it's not just to check boxes. I think what you see is by having multiple perspectives that can look at problems or opportunities in a slightly different way, you're just increasing the likelihood of success for that company or that moment in time. So extremely important, and it does well for the investments that they've made.
For sure.
To have multiple
and
viewpoints.
the more founders that are, you know, having a hard time getting in, like really be intentional about receiving venture capital funding, because that's how we create that change, right? Once we get in, we can start to really like fix what's going on. And so, you know, a lot of things that I say, when I say it, it always seems very combative, because it's like, man, he's saying this. Why does he want to raise venture capital then? It's like, because that's how we create the change. We get in, we create our own boards, we find other ways for, where we come from, people from where we come from to, you know, get resources to funding like that, right? And so the more people that try to attack this situation and really raise funding the right way and build your business the right way and all those things, I think that's how we create the change too. Venture capital is this scary big thing from the outside, but on the inside, truth be told, it's a lot of followers, right? So one person invests, okay, well, now I'm gonna give you some money, right? And so with that being said, you wanna create this buzz and this narrative for your business that we don't actually need you. Figure out how to share your story and tell your message, right? That's really how you get their attention, for one. So a lot of times you might not have to make the intro. They may come to you based on things that they've seen elsewhere, right? And you want to create that. And that's a big thing because venture capital, there's this thing that, for those that don't know, right? It's really smart, I guess, to create a buzz by gaining a lead investor, right? Having somebody that's going to back you throughout the round that you raise. And with that being said, what that's really saying is that if somebody else does it, then I'm ready, right? And so you want to create that, like you want to find ways and get creative to create that buzz, because as big as venture capital is and as scary as it seems from the outside, it's a world full of people that just follow the next person.
And it's subtle. So I think part of it is, you're right, you have to build the market through social media and kind of subtly position yourself in the middle of it. So you can't really say, hey, we're the greatest. What you want to do is kind of socialize the problem, and that you're kind of one of several that are good, that are solving it, but you're always the one that is educating the market. So that's extremely important. You have to make it look like it's something to get in on, so they'll want to rush in, because being that first one to lay the bet down is always dangerous for a venture capital. So you have to really learn how to create the own buzz. You can also use board members. I keep saying that. Conveniently, we now have a board, so we can do that. But we have some board members that are really great about understanding what our capital requirements are, what round one, and they will very proactively make calls on our behalf and just say, then it's more bro to bro, right? Exactly, it's kind of like, hey, we're in this deal and you should be too. And then by the time we get on the phone with them, they're warmed up. They kind of feel like another investor's in. And one of our former investors might say, we're going to come back in. We just need a lead. Here's why you should do it. Here's who else we can bring into the deal. Because one thing the lead doesn't want to feel is that they're out there, they've put in, let's say, $500,000, and then you're not going to get where you need to go in that round. Let's say you're trying to raise $2 million or $3 million. If it can be socialized by a board member or another investor, it doesn't have to be a board member, but just saying, hey, we're going to come back in and we have this network. That's one benefit of having investors too, is just they've got these networks, and you want to feel like they're going to keep socializing the deal and socializing the deal, so they'll bring in others with them as well.
Sure. And another thing to even think about, you have to start getting creative to create that buzz for venture capital firms, right? And so my lead investor for my seed round was literally a tech company that built my product, right? So it's just like, that's something that doesn't happen often. That's rare. People don't even, I don't even know if I've actually heard of things like that. But even with that being said, I got creative, and then as soon as we announced it, all the VC firms hit me back and was like, all right, well, I see that you have this, I see that you're doing this. And so you just have to be very, very creative in this, because it's not only one way to raise money, for sure. And it's not only one way to finally raise venture capital money, right? There's steps to that, and you just have to be creative, so.
I want to get specific to Kansas City, and Heidi, you're a serial entrepreneur. You definitely have some exits under your belt, and you were talking about experience across the nation. So how does venture capitalism in Kansas City compare to some of those other regions that you're mentioning with the culture here?
I think one is just the domains that Kansas City is going to have more depth and familiarity with, which is why we relocated Kenzen, which is an industrial workforce safety company, from New York City to Kansas City. It's just much more relevant here. I mean, we look at us as positioned very much in the center of the industrial Midwest, right? Kansas City's right in the crossroads of everything. In fact, we are based technically right in the crossroads. So we're close to Colorado, we're close to Utah, also Ohio, go up to Minnesota, go down to Texas. We're right in the middle of all of that. So we have very easy access to customers. And like on the technology side, first of all, everything is going to be less expensive, more affordable. Hiring top tier talent in the Midwest, generally hard stop no matter what you're doing. But for us, we're working with sensors and we're working with scalable mobile technology platforms. So we can pull from Garmin, we can pull from Cerner, we can pull from T-Mobile for all those technology requirements. And then we've got so many construction companies, engineering firms. So we're going to have those individuals that understand industrial workforce management in some way, project management, have been on a site, can go on, talk to workers. Maybe they've been in the military a little bit too. There tends to be more concentrated of that in the Midwest, and that connects very well on the work sites. We feel really well supported on all those fronts in the Midwest. So that is why we chose to be here, domain expertise. I'd say taking it away from domain and just looking at how are Midwest investors different from those on the coasts, I think if, Silicon Valley in particular, you can generate a pretty crazy valuation just based on an idea. When you get into New York and Boston, they want to see a little bit more revenue. So they're a little bit more practical for sure. And I think in the Midwest, it's even more conservative, right? So there needs to be more lockdown, more customers. And in the climate we're in, you do have to do an awful lot of promotion, both for customers, investors, and just market development in general. And that's just building value for your company.
And that's something I feel like we've leaned in heavy on. Like you said, you get the bang for your buck, right? So if you raise a $500,000 seed round, you can hire some top level talent from this area and still have money to do whatever else you need to do, right? And so you have to kind of just weigh your options. And with technology being the way it is and the gig economy growing day by day, it's easy to pull talent from other cities and other states, right? And so having a base where your funding lasts is very, very important, right? And understanding based on that market, if you raise a certain amount, can you get everything that you need to get done, right? And so I think the Midwest definitely is strong with that. And like you said, I think the Midwest is behind when it comes to just the social aspect of the world, like not even just social media, but in-person experiences and different things like that really matter in the Silicon Valleys, the New Yorks, right? The reason that those cities are so hybrid is because of that. Like they really dive in on the social piece. The reason I can give you $2 million is because I see socially you impact a lot of different things, right? So your idea is great, and socially you're gonna touch, 12,000 people every time that you do X, Y, Z. I can give you that money, right? And that stuff matters in other states, right? And I think here it doesn't, right? So, coming with a social media following or, having a big social impact on things don't really matter as much. And I think that's where, that's a little piece that I think the Midwest can start to capitalize on as the world becomes a lot younger, the world becomes a lot different. Like even if you're not building a nightlife business, even if you're building any business, the only way that it's really going to get out there is if you have a very strong social impact. At some point that has to matter, and I think the Midwest is catching on. I'm not saying that it's not, but I think that's the piece that it's missing is understanding that aspect of it, because it's in all the other cities and all the other states when you're raising venture capital, that's what matters.
So I feel like I see that happening a little bit with the industrial Internet of Things. There's several of us that have a startup that is based on the industrial ecosystem, and we're starting to get together more. We're starting to organize times when we'll just talk shop, and that's exactly what it takes. It's just that cross-pollination of information and a fast pace and an exciting growing space. So I think Kansas City is all the makings of it. It's just a little bit more spread out too. Yeah. It's never gonna have the density of New York. It's just not gonna happen, and that's okay.
Well, Josh, Heidi, both from different ends of the spectrum in cases of experience and businesses, but it sounds like y'all definitely had some intersections of the past experiences and present. So thank you so much for joining us today. We really appreciate you taking your time.
It's great to be here.
No, I appreciate you guys having me. Thanks.
We're drinking coffee in the morning. We're strategizing, storyboarding. This is how we start each day.
Hey.
Good morning.
Pulling up to the scene with the sis team. Do 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 do. Lights, camera, audio.
Check.
Setting you up to look your best. You can trust our team, we're here to help. Now we're back at the studio. Oh, time to make your video glow. Small but mighty, watch us grow. Bookstellar Image Studios.
Shopping for insurance for your personal or business needs used to be difficult. We're Milo, and we're here to change that. Milo is a digital agency that recommends the right coverage carrier and helps individuals and small businesses find the right insurance to meet their needs. Just answer a few easy questions. like who you are, what you do, and some details about the insurance you're looking for. Whether you shop online or with a Milo agent, our AI-powered recommendation engine, the Mind of Milo, draws on 50+ years of insurance experience to explain what protections you need and find you the right policy at the best value to protect your long-term financial future. Milo is a one-stop shop platform that allows you to buy coverage for your home, your auto, your business, your life, your health, all in one place. In addition, our partners can take our capabilities and embed them in their platform to offer insurance to their clients as well, which makes it easy to find the right insurance while starting a business, closing on a home, consulting a financial advisor, and taking care of other important business. And there's no cost to you, only expert advice and the best value. At every stage of business or life, Milo's award-winning platform is ready to help you out. Choose Milo.
I'm joined now by Shawn Hoyer with Bank of America. Shawn, how are you doing today?
Good. How are you, Austin? Good to be with you.
I'm doing great. It's great to connect with you virtually. You are an expert in this topic. Why don't you tell us a little bit about what you do with Bank of America, but also just kind of your background?
Most of my 22 years in banking has been working with private companies, entrepreneurial-backed companies, throughout different capacities, whether it's been lending to private companies, raising capital for private companies. But the last 4 years, I've now been sitting in the position within the investment bank at Bank of America, leading our venture capital coverage practice. So what does that mean? Venture capital, as we know, has become a very significant force in private capital raising. Most of the companies that are going public today are currently venture-backed. These are investors that have been investing for 5-10 years in these types of companies are now seeing the rewards. And then certainly the onslaught of private capital has made venture capital even more pronounced, as more and more of these what were perceived to be venture companies are now becoming very large. And so my investor base are the top 25, top 50 venture capital firms in the world, consisting of the Sequoia Capitals, the Excels, the Bessemer Ventures, folks like that. And my primary function with those investors is their portfolio companies. I do sit within the investment bank, so it tends to be transaction driven, either IPOs or raising private capital rounds. Usually those larger last private rounds before a company looks to go public or sell. And it's a global practice, so I work with investors all over the world in venture. A large predominance, a small number of venture capital firms carry a significant weight of the overall economics in overall returns. But I also have good connectivity with seed investors in Latin America, Europe, something that certainly borders are continuing to break down.
As far as trends go in VC right now, we touch on a little bit of the things you're seeing there now, but I'd be curious if there's maybe one or two standout things in VC as a whole at this point in time that really stands out to you as a trend.
Capital it used to be a San Francisco story, right? A West Coast story or an East Coast story. It wasn't something that you found in Europe, in Latin America, in Asia, right? Countries all over the world. It was if you were going to raise meaningful capital, you were probably going to have to move your company to San Francisco, right? To the US, if you happen to be a European company. So I think that's one thing that has changed, right? We all know how rapidly valuations have increased in the United States, especially in areas like San Francisco, New York, that what capital providers are realizing, because now we're somewhere around over 4 trillion in private capital today that is looking to be put to work, right? That's a lot of money. And only so much of it, if you are a fund looking to return capital to your limited partners, to your investors, it's getting harder and harder to make those returns given the way valuations have crept up. And so what you've seen is most venture firms are shifting out of the United States to move their focus to where they can get better returns on these types of deals in places like Europe, whether it be places like Australia, Latin America, certainly Asia has been its own isolated story. So the borders have really come down, right? You no longer as an entrepreneur have to feel that you've got to pick up your company, and if you're going to get the right talent, right, certainly work from home, the ability to have far-flung teams has improved dramatically with the support of technology. So now that's probably one of the biggest trends, is that if you're a good company, capital will find you. And it's gotten so competitive in the capital landscape that there are teams and teams of analysts at these firms trying to make sure they uncover every interesting company around the world. So I'd say that's the first trend. I think another interesting trend that I think is up for debate, and certainly among my client base, which is so much capital has now gone into investing in growth companies, right? Private technology companies. All of the returns, the predominance of returns coming in the public markets are from software companies, from consumer internet companies, right? All that most of my investors have invested in the past 10 years. There's an argument to be made that investing in a software company 10 years ago, very risky. Very unsure about the pathway to figure out, will this company be successful? What are the metrics? What's the go-to-market motion for a software company? A lot of that has been figured out. Yet the returns have been so strong in software, we're now at this interesting dilemma where venture capital continues to double down on things like software because that's where the returns have been. The challenge is, as that gets de-risked, you would expect capital to become cheaper, for lack of a better term, or more competitive, right? And so what you're now seeing, you're seeing large asset managers, hedge funds, private equity funds that have many billions of dollars, where if a venture firm has a $5 billion under management, that's a very meaningful venture capital firm. Now you've got big money where $5 billion may be a rounding error, that are saying these investments, investing in software, investing in internet companies, has become de-risked. So we're willing, because we're a lower risk investor, we now view this as a lower risk. And so the debate I think that's happening in the venture world is, are you going to see big funds get bigger to write bigger checks because the margins are getting smaller, so the way they're going to provide returns to their investors is investing big checks into big deals and doing it strictly with deal size, right? Check size. Or are you going to get venture capitalists going back to what venture capitalists used to do, which was they were the only people willing to invest in a given sector or a given technology, right? You've seen the pull forward of frontier tech, whether it's autonomous driving, new energy sources, food alternatives, right? That still have a lot to prove. Maybe that is the area that venture capitalists who are truly looking for returns go back to and start writing those kind of checks. I think you're going to see probably a bifurcation in the venture world where you're going to have large funds that will lose the word venture altogether, because they're going to do everything from investing in venture stage companies to late stage companies. And then you'll probably have a very small group of investors that are focused only on investing in early stage companies, right? So I think that's one of the bigger trends. And part of it is just, you're just continuing to see more and more pressure of private capital coming from all angles, right? Family offices used to write a few $1 million. Today they're writing a few $100 million into deals. So it's a very competitive landscape right now, which is ultimately good for entrepreneurs.
And I wanted to touch on Kansas City specifically a little bit now, but just to kind of give you a little bit of insight from what we've seen here on our end, and then to pick your brain a little bit here. We're seeing, obviously, sizable rounds still coming through with those out-of-state investors. We've been seeing sort of an uptick in exits, it feels like, maybe even some startups exiting a little bit earlier than you might have anticipated. But we're also still seeing people leaving the area in search of capital. What would be your experience, or what is your experience kind of with VC here in Kansas City? And are you seeing any of those things, or kind of what is your perspective there?
when the pandemic first started, right, everybody said, I don't know if we're going to be able to make an investment in a company that we've never met. Now investors are doing a lot virtually, right? We expect that to continue. Private equity there have been private equity firms I've worked with that used to say, if it doesn't take me at least 2 flights to get to a company, it's probably not the right deal. It's probably a deal that's everybody's seen. So I think venture is adapting to that idea that they can effectively be of benefit to an entrepreneur in building a company that they don't necessarily have to be in the backyard, right? So I suspect that that will continue to change. I think what you are seeing, and I think a lot of these patterns are going to stick, which is if I'm a computer engineer and I've always wanted to work for one of these cool startup companies, but I just don't want to live in San Francisco, right? I don't want to pick up and move to Austin because I was born and raised in Kansas City. That's where I'd like to stay. No longer are you relegated to, well, I guess you're not going to be able to work for one of those companies, but more importantly, your ability to start a company and get capital attracted. I think more and more venture investors are looking for those opportunities of, and I think what you ultimately see too, you see better company behavior when you're not in San Francisco, right? You get people who have started companies with the idea of creating a going concern, creating a company that will make money, a company that actually stands the test of time, versus the Bay Area model of go big or go home. We don't care what you have to spend to grow top line. I think that's a challenged model as well, where people are saying, if you can find me a $10 million, a $5 million software company in a city like Kansas, in a city like Kansas City, that has been capital efficient, hasn't raised a tremendous amount of outside capital, that becomes really compelling for investors to get in early into these types of names where they can see the opportunity and they say, we can help expand the revenue opportunities for this business because of our connections. And so we can turn this into a $50 million company. We can turn it into a $100 million company. But the benefit is we were able to get in when not 15, 20 other investors were in front of the business before we were. So I think that all of these cities, you're going to see this rise. I mean, I think it plays into Revolution's thesis and Steve Case's thesis around rise of the rest, that no longer can I only get the best technical talent in San Francisco. Actually, now there's a lot of people moving out of San Francisco who are moving to other smaller cities because they want that lifestyle adjustment. And so now talent is proliferating to every corner and every state. And you're seeing that in the numbers, that venture capital investment continues to increase at the regional level, and you're seeing it being pulled away from Boston, New York, and San Francisco. Now, the benefit is total dollars raised have continued to be massive, so those areas aren't seeing a dip in capital, but what's really positive is you're seeing regions throughout the United States continue to get more and more incremental venture capital invested in their cities and states.
And as far as the companies here in Kansas City go, do you hear any buzz about any particular startups in your part of the world and in the conversations that you're having?
I've been fortunate to be in the Kansas City area and get a chance to meet a couple of companies, and you know, Shot Tracker I think is a really neat technology. I said I'm a sports guy. I think you're seeing again, right, this ability for a company to really have meaningful investors, meaningful support, but also a technology that is really, really interesting to a lot of people that, again, happens to be based in Kansas City, right? Somebody like a Replica, somebody like a Torch.ai. That's a good example of a company that I don't think people know really exists yet, right? And it's been a company that's operated below the radar in a very interesting space when you look at some of the companies that have gone public, like Palantir, C3.ai, right? These entities that have gotten a lot of attention. And when you find a company that has good scale and good growth, but also very capital efficient, those are very interesting stories. And so my investors probably get the most excited when I reach out to them and tell them about a company that I've met in in Buffalo, in Kansas City, right? In Plano, Texas, that they just didn't know were there because they wouldn't suspect there would be that type of company there traditionally.
And I want to talk a little bit about our local firms here in Kansas City. So I have this statistic here from our last year's VC-backed companies report, which was in 2020, 23% of funding, VC funding, came from Kansas City area investors. Now, when you hear that number, as far as local support for startups goes, is that a good number, or should we be aiming for that to be a little bit higher?
Anything in venture, right, in life in general, but success begets success, right? I mean, part of the reason that there's been such a rise of capital, and it stays that way between San Francisco, New York, and Boston, is because there's been success in San Francisco, New York, and Boston. That liquidity gets generated, and it gets reinvested into the next startup. The CEO that made $100 million decides to stay in that area. She starts a new company and she raises additional capital, and that gets reinvested in the entrepreneurial economy. I think what you're now starting to see in a lot of these cities is you're seeing these operator-led rolling angel funds, where you get a group of successful business people that have created companies. Maybe they haven't sold them, but they've got good companies that they've created, right? They're collectively among 6 of these entrepreneurs. They decide, you know what? We're entrepreneurs. We've built companies. We know how to run a company. Why aren't we investing? And I find in a lot of these cities, it's entrepreneurs that have created a lot of value in these cities want to invest in other entrepreneurs in those cities. So ideally, do you want to see more successful business people? And I'm not talking about just tech, right? I'm talking about any industry that might be in a city, that these leaders come together and create these rolling angel funds that provide a lot of that initial seed capital to really kind of invigorate the entrepreneurial economy. I think you're starting to see that more, certainly in cities like San Francisco and New York. But I think every city probably is starting to see that building of those networks, because I think that group of investors, as the venture world, the traditional venture world, because of the pressure that we talked about on the front end about more capital chasing fewer deals, right? Their checks and their entry points are getting later. So I think the rolling angel funds will play a much greater role in building out the ecosystem in a given city or a given market, because the venture capital guys will want to write bigger checks and later. So I think those rolling angel funds, you want to see that number increase, because I think it'll just be a meaningful underpinning for creating that type of environment. Then the other thing that I'll say too is that, you know, it takes a mindset shift. It's kind of a chicken or the egg discussion when we've seen this, if you look at Israel, right? 10 years ago, most Israeli founders would typically sell their business, right? I mean, if you live in Tel Aviv and somebody offers you $100 million for your company, you're kind of like, you know what? That's a great outcome. I'll be comfortable. Thank you. But now when you go into Israel, the idea of selling your business for $100 million, no, I believe this can be a multi-billion-dollar company. And as a result of that mindset, now part of it is, well, there's more capital flowing in, so entrepreneurs are realizing they can get the capital to take this business to the next level. But I think as more capital finds its way, more people start to realize that, you know what, I could sell my business. I could, but I actually choose not to, because I think there's a lot more value to create here. And I think you're seeing a lot more interest from entrepreneurs in their own cities, right? UiPath would be a good example. One of the largest IPOs ever. We were involved in that IPO. It's a Romanian-based company, and it's worth $30+ billion today. The idea that 7 years ago you would have told me there would have been a $35 billion company based in Romania, I would have said you're crazy. And more importantly, Daniel Dines, the founder and CEO, specifically didn't want to move his business to the United States. Yes, he has operations in the United States, but it was very important to him about the overall economy and building up of the country of Romania. And so that I think founders also have that piece to them that says a lot about where they're from.
And in our final few minutes together, I want to talk a little bit about IPOs because of those companies who are, as I mentioned before, we've had companies who have exited, but also those companies that you're talking about there who are maybe holding out a little bit longer. What would you tell them to prepare them in this particular state of our world to prepare for an IPO if that's something they're looking to do?
The first thing I would say is be careful what you wish for. Being a public company is being a public company, and I think oftentimes people view that as some sort of a finish line, when that is just yes, it's creating liquidity, but today, again, given private capital that's out there, there are a lot of options, right? When we would sit down with an entrepreneur and we would talk to them about strategic options for their business, you used to say there's an IPO and then you could sell the business. Today, there's probably at least five different alternatives a company can be thinking about. Maybe we'll stay private and we'll raise $100 million. Even if we're at scale and we don't need the money, maybe we decide to raise $500 million that allows us to continue to create a more mature company to be ready to be public, right? You have this whole SPAC phenomenon, the special purpose acquisition corporations that are out there that are creating a different type of avenue for companies to be public. You do have the option to build out a fulsome M&A strategy, right? Potential sell to a strategic or a potential strategic investment in the company that allows you to maintain control in your destiny. So no longer is IPO the only option an entrepreneur should be thinking about. First and foremost, they should always be figuring out, am I ready to be a public company? I think we're starting to see that in the SPAC environment, that a lot of companies who became public through a SPAC maybe perhaps weren't ready to be a public company. And that can be, I think, a challenge for a lot of these entrepreneurs. So it's size. There is still a size and scale that a company should be to be a public company. So usually at around 75 million in revenue, 100 million in revenue, now you're getting to that size where you can start thinking about those types of opportunities. But the bottom line has never changed. Great companies have a lot of options. They can go public in bad times, in good markets, bad markets, right? If it's a good company, you've got tremendous options out in front of you. And the good news today, being an entrepreneur, you can't pick a better environment today because, again, there's just so much capital chasing fewer deals. More capital wants to be put to work. And it's not just coming from the venture world, right? It used to be if you were going to raise $5 to $40 million in capital, you were going to talk to a venture capital firm. Today, you can talk to a hedge fund, you can talk to an asset manager, you can talk to an insurance fund, you can talk to a family office, you can talk to a traditional private equity fund that has a growth venture sleeve, or you can talk to venture investors, or you can talk to successful entrepreneurs. We're now seeing that there are entrepreneurs that have had big exits from their companies, and they're not a VC firm. They're an individual investor, but they're writing $50, $75, $100 million checks personally, right? So that dynamic, what we always encourage, if a company decides to look at raising private capital, think about who you want sitting next to you in the boardroom and why are they there? Are they there just because of capital? Are they there because you want them to open up new revenue streams? Are they there because you need some sort of operational expertise, right? That, I think, is the bigger challenge for entrepreneurs to decipher and think about is, wow, this is great. I can raise capital because there's a lot of capital out there, but it has very different forms. So just the way you should think about, am I ready to be a public company? If you're staying private, continuing to raise capital, you should be thinking about, who do I want sitting next to me in the boardroom, and what value are they bringing outside of just quantum of capital?
And lastly, for those founders watching today who are maybe in that angel phase, they're running on angel investments, they've got friends and family, they're starting to look towards that first venture round. What is your biggest piece of advice for those people as they look to take on that first initial injection of capital?
I think for me, it's understanding the addressable market that you are going after, understanding the the competitors in that market, but having a really good product. Similarly, great companies can do great things. You could probably take that down a layer. Great products that are built by companies give them a lot of flexibility. And more, I think investors want to dive into the strength of the product, right? Because if you can find one customer to buy a product, two customers to buy a product, what's really meaningful when you have multiple customers saying, I love this product so much, when they come out with another product, I'm absolutely going to buy it, right? Like that's the technology speaking for itself. That's the product speaking for itself. So make sure you've got a really, really good product, right? Because all of the other stuff, right, telling the story and how you're going to change the world, at the end of the day, it's going to come down to the IP that is created and controlled by that founder. And investors at the early stage are going to want to talk to the creator of the technology, the creator of the product, and really be able to go deep and have a defensible story around why this product is better than what's out there. Who are you selling to and who are you taking business from, right? That understanding everything around that product, I think, is really important. So I would say at the early stage, product first, right? Again, if you have a great product, capital will find you. You will have plenty of opportunity to raise capital if you've got a great product. If no one's interested, you might have a more challenging product.
Well, Shawn, thank you so much for joining us today. I really appreciate you taking the time for this conversation because I do believe it will help a lot of people here in Kansas City who are looking to kind of get to that next level as far as funding goes, but also those people still navigating those various rounds and looking to get to that place of exit. So we appreciate you being here. We appreciate Bank of America's support as well of Kansas City's ecosystem, but also of this conversation today.
Really appreciate it, Austin. Thank you.
I'm Melissa Vincent, and I am the Executive Director of Pipeline Entrepreneurs. Pipeline is a year-long fellowship for entrepreneurs who happen to call the Midwest home. And our goal is to help those entrepreneurs grow and scale their companies and hopefully get to an exit. It has been this amazing 14-year history of creating some of the most successful entrepreneurs in the region, and we want to make sure that everyone is included in that conversation. And so for the future of Pipeline, we're actually expanding our programming to add a new program that'll be specific for female, minority, and rural entrepreneurs. And our hope is that with this Pipeline Primer program, that everyone will have an even playing field to get into Pipeline. So if you're an entrepreneur and you're in the region and you are looking to really grow and scale your company, I would say apply to pipelineentrepreneurs.com. We are about to start our new recruiting season, and for the first time ever, we have 2 recruiting classes.
This edition of Startland News Reports is sponsored in part by C2FO, a Kansas City-built fintech leader putting the management of working capital in your hands. Whether you need to accelerate or extend AP and AR, or are seeking an innovative way to optimize your cash, C2FO's secure online platform enables you to make quick cash flow decisions for your company, your suppliers, and your customers. Learn more at c2fo.com. That does it for this edition of Startland News Reports.
Thank you to Bank of America, Milo, the Kauffman Foundation, C2FO, Pipeline, and everyone who made this year's VC-backed companies report possible.
And thank you to the audience at home. We look forward to you joining us for our next special in November for Community Builders to Watch 2021.
Until then, we hope you stay safe and healthy. You can visit startlandnews.com 24/7 for more bold, untold stories of innovation starting right here in the nation's heartland.